Hello everyone. We are starting with the long answer questions and solutions in this video. Be very careful, they are supposed to be long answers, okay? So it will be a long video as well. So first question, do you advise that assets and liabilities must be revalued at the time of admission of a partner? If so, why? Also describe how is this treated in the books of accounts. So now see, in these type of questions, you just have to write whatever comes to your mind, because as we are solving the questions, we know all the steps, how to treat that. So yes, it is advisable to revalue the assets and liabilities at the time of admission of a new partner for ascertaining the true and fair value of assets and liabilities. This is done because the value of assets and liabilities may have increased or decreased, and consequently their corresponding figures in the old balance sheet may be either understated or overstated. You remember we wrote all these things in our previous video where we were doing the short answer type questions. Moreover, it may also be possible that some of the assets and liabilities are left unrecorded. Next, thus, in order to record the increase and decrease in the market value of assets and liabilities, revaluation account is prepared, and any profits or losses associated with this increase or decrease are distributed among the old partners of the firm, also in the old ratio. So okay, just write here, it will be distributed in the old ratio. Okay. So this will be distributed amongst the old partners in the old ratio. Next thing, they have also asked us to do the accounting entries. Yes. So accounting entries, okay, I have divided into two parts, this and this. So accounting entries in the books of accounts. So the following journal entries are recorded in the revaluation account on the date of admission of a new partner. I hope this is visible to you. Yes, this is. So for increase in the value of assets, see, assets, wherever we have to increase the value of asset, we have to debit, because assets have positive debit balance and negative credit balance. So assets debit to revaluation. For decrease in value, just the opposite, revaluation to assets. For increase in liabilities, revaluation to liabilities, because liabilities have credit balance, positive credit balance. So to increase a liability, you have to credit it. And what you will debit? You will debit the revaluation. Also, the opposite, to decrease the liability, decrease liability to revaluation. For recording the unrecorded assets, so a new asset is as good as new asset is coming in. So assets, unrecorded assets to revaluation, unrecorded liability to record, it's a new liability coming in, so revaluation to unrecorded liability. Now, for transfer of the credit balance of revaluation. So if there is a credit balance, so we need to close the revaluation account by debiting it. So revaluation debit to old partners, and if there is a debit balance or revaluation, what will happen? Just the opposite entry, okay? In case of debit balance of revaluation, what will be the entry? Old partners, capital account, debit to revaluation account. This is the last entry. I guess I have not incorporated this in this slide. So question number 2 now. See, first question was actually very short one. Now the second, third, fourth will not be a short question. So what is goodwill and what are the factors that affect goodwill? So goodwill is an intangible asset. Do you remember the important words? Okay, here the important words are what? Goodwill is an intangible asset. It is the value of firm's reputation and the good brand name in the market. Goodwill ensures greater future profits, as there will be greater number of satisfied customers in the future. As in the word of Lord Eldon, goodwill is nothing more than the probability that the old customer will resort to the old place. So old customer will keep on coming to us, and that's the goodwill of the firm. Okay. And they have also asked us what are the factors that affect goodwill. So these are the characteristics of goodwill or the factors that affect the goodwill. So the following are the characteristics of goodwill. It's an intangible asset, it's not fictitious asset. It is difficult to ascertain the exact value of goodwill. It enhances the future as well as the present earning capacity of the business. It helps in earning supernormal profits against the normal profits, and it assists in business to enjoy upper hand over its counterparts. So these were the characteristics. I guess the factors will come now. Yes. These are the factors that affect goodwill. So the following are the important factors that affect the goodwill of a firm. First is quality products. So if the product of the firm that the firm produces is of good quality, there will be higher goodwill, okay? Or if it's of inferior quality, then there will be no goodwill. Second is location. Let's say the firm is situated at Connaught Place or at Nariman Point. These are the superb places in Delhi or Mumbai, okay? So if the firm is situated there, then obviously the goodwill will be higher. You all must be knowing the 5-star hotels, they generally tend to be situated at the poshest localities. Why? Because they'll enjoy greater goodwill over there. Then the management, just imagine in my firm, Mukesh Ambani and Ratan Tata are also partners. So of course, I can use the name, Kisi, one of my partners is Ratan Tata, another is Mukesh Ambani. Just imagine the goodwill of my firm. So management, market structure. Let's say I am in a market which gives me the benefit of being a monopoly firm. Only I produce, no one else can produce that product. Okay, it's a monopoly. Then what will happen? Then I'll enjoy superb goodwill. Okay, this is an amazing company because assured profits are there. And then economies of scale. What is economies of scale? That you learn in economics. But I'll tell you, like China, what it does, whenever it starts a factory at a very big, very large scale, big machineries, huge factories. Why? So that per unit cost of production comes to very less. So if I produce this calculator in India, it might cost me 100 rupees, but the same calculator can be manufactured by China in 50 rupees or 40 rupees. Why? Because they produce at such large level. That's called economies of scale. So if I enjoy economy of scale, market will see me as a superb firm and my goodwill increases. So these are the factors. Obviously, if the question comes in the examination, you have to explain this. Okay, I have not explained because you can do that in your own word. Whatever I just said, you can just jot it down and you can write the answer. Now, this is a very good question. I guess 7-8 pages will go in this question. What is this? Explain the various methods of valuation of goodwill. Now, this being a very long question is the easiest question. Why? Because all these steps are in our mind. We have solved these, how we valued goodwill with these steps in our previous questions. Okay, so the following are the various methods of valuation of goodwill. The first method is average profit method. Okay, in average profit, what happens under this method? Goodwill is calculated on the average basis of the profit of the past few years. The formula for calculating goodwill is average profit multiplied by number of years of purchase. So number of years of purchase implies number of years for which the firm expects to earn a same amount of profits. So this is the easiest one. Okay, we all can do this in our sleeps. Now, what are the steps to calculate by average profit method? First, find out the past profits. Okay, add all abnormal losses like loss by fire and theft. So abnormal losses are added. In the same way, abnormal incomes. Okay, add all normal income if not added previously. Okay, this also should be added. And what is to be subtracted? Non-business incomes and abnormal gains and incomes like speculation, lottery, etc. These are abnormal things, should be taken away. Okay, if there are abnormal losses, add it back. If there are abnormal gains, reduce it. But if there is a normal income which we did not add previously, okay, add it now. And less normal expenses if this was not deducted previously. And in this way, calculate average profit by dividing the total profit ascertained in step number 5 by number of years. And finally, multiply the average profit to the number of years of purchase that is given in the question to calculate the value of goodwill. This was average profit method. Now, this is weighted average. Okay, that was simple average. Now, this is weighted average. So, it is modified version of the average profit method. Under this method, the weights the weights are assigned for each year's profit. Okay. Yes. Highest weights are assigned to the recent year's profit and lower weights are assigned to the past year's profit. The products of the and the weights are added and divided by total weights to calculate weighted average profit. The formula for calculating goodwill by this method is total products of profit divided by total of weights, and goodwill will be weighted average profit multiplied by number of years of purchase. Now, what are the steps? First of all, assign the highest weight to the recent year's profit and the lowest weight to the past year's profit, like 4, 3, 2, 1, like this. Multiply the weights with the corresponding year's profit. Calculate the total of the products. Divide the total of the product by the total of the, it's not eights, it should be weights. Okay, total of the weights. Okay, in order to calculate weighted average profit. And last step, multiply the weighted average profit by number of years of purchase. So it's multiply sign, number of year of purchase. The third one is super profit method. This is the method which is generally asked in the question also. So, under this method, goodwill is calculated on the basis of excess profit earned by a firm over the normal profit earned by its counterparts in the same industry. So, the excess profit over the normal profit is termed as super profit. Steps to calculate goodwill by super profit method. Now, what are the steps? Calculate average profit. Okay. After calculating average profit, calculate the average capital employed. How to do that? Opening capital plus closing capital upon 2 is the average capital employed. Or if this is not available, then capital employed is all assets minus goodwill minus fictitious assets minus external liabilities. So these are the capital of the firm. Then calculate normal profit by the formula average capital employed multiplied by normal rate of return upon 100. If average capital is not available, then you can just find out the capital employed. Then calculate supernormal profit by the formula. Supernormal profit equals to average profit minus normal profit, and multiply the supernormal profit by the number of years of purchase to calculate goodwill. Do you remember? If super profit is a negative, then there is no goodwill. You have to stop the question here only. Okay, you don't have to go on to multiply. There cannot be a negative goodwill. Okay, so super profit cannot be negative. That means super loss is not possible. And the last method is capitalization method. Okay, now under this method, goodwill is calculated by the following two methods: by capitalization of average profit and by capitalization of super profit. Okay, so let's see. Capitalization of average profit steps: calculate average profit, then calculate capitalized value of average profit by the following formula. How? Capitalized value of average profit is average profit that we just calculated multiplied by 100 upon normal rate of return. Then let's find out the ascertain actual capital employed and deduct actual capital employed from the capitalized average profit to calculate goodwill. And finally, goodwill will be capitalized average profit minus actual capital employed. And the last thing, which is in fact the last thing for this lecture also, we will not do the entire all the questions in this video. I'll be stopping after this slide. So what is this? Capitalization of super profit. Okay, it's a little different. Calculate the capital employed, calculate the normal profit by the following formula. Normal profit is average capital employed or just capital employed multiplied by normal rate of return upon 100. Calculate average profit, calculate supernormal profit by following formula. Supernormal profit is average minus normal profit. Calculate goodwill by the following formula. Super profit multiplied by 100 upon normal rate of returns. So do remember these, okay, there is a difference how to calculate by capitalization of average profit and capitalization of super profit, okay. In this video we are stopping here. Rest of the questions just see the next video. Thank you.